Good afternoon. I'm Carla Dennis, and I'm going to talk to you about the tax implications for short sales and how you can utilize a short sale to rebuild your wealth. Short sales have become very popular over the last couple of years, and a lot of individuals have to utilize short sales in order to readjust their portfolios, sell a piece of property that's no longer income producing or performing in their real estate portfolio in order to rebuild their wealth. Perfectly okay tool, and from a tax perspective, it can benefit you depending on your unique situation. In a short sale, we have two transactions that we need to be concerned about. One, we need to be concerned about the sale of the property and the tax implications of the sale. And two, we need to be concerned about the debt relief from selling the property short and not paying off the loan in its entirety. Let's talk about the sale first. For an individual that has not cashed out refi, the sale of the property is going to be the fair market value of what the lender could have gotten or what you actually sold the property for, less your cost basis in the property. And this is going to be, remember, what you purchased that property for, all the additional costs you added to the property. The difference between those two numbers is going to yield you a loss on the sale of the property. That loss actually flows over to your personal income tax return as an investment loss. So as an investor, you're going to be able to utilize that loss to mitigate other income on your tax return, whether it be self-employment income, W-2 income, or the gain on sale from another piece of property. This loss from the short sale will flow over and help mitigate your taxes, thus lowering your income taxes, allowing you to get rid of an asset that's not performing, and giving you room to rebuild your wealth. Now that's the first thing we have to be concerned about. The second part of the short sale that we want to be concerned about is if you did a cash out refi on that property. Remember, we talked about your basis in the property, how much you paid for that property. Any money that you may have cashed out from refi and utilized for another reason is not going to be counted in your basis of the property. Therefore, you may have a larger loss from the short sale if you had not refi. Just something to take into consideration. The other thing about a short sale that we want to talk about is the debt relief. Anytime you sell a loan short, the bank is going to 1099 you back debt cancellation. And that debt cancellation is going to be reported on your tax return as ordinary income, subject to ordinary income tax. But remember, we're going to have the loss from the short sale flowing over. We're going to have the report of the income flowing over. And they should be pretty equal, except for if you did a cash out refi, then the debt relief is going to be greater than the loss on the sale of the investment property. Short sales are excellent tools to utilize to rebuild your wealth. Make sure you look at your tax return, get somebody to figure out the tax implications so you can know exactly what you're dealing with. But if you have the opportunity to restructure your portfolio, you have to do a short sale. Don't walk away for it because it's a tool to utilize to rebuild your wealth.